Supermicro stock went up 22% after beating analyst estimates. The company reported first quarter revenue of $762 million, which was down 4.8% from last year. But the reason the stock went up is because it beat analyst estimates by nearly $5 million. Let's run their financials through a discounted cash flow model to see whether the stock is a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Supermicro stock by analyzing their financial statements and dissecting their financial ratios so we can determine if the stock is a buy or a sell. Supermicro is an information technology company founded in 1993. The company specializes in servers, storage, networking devices, cloud computing, big data, and high-performance computing. It was ranked the 18th fastest growing company in the United States. Let's get started with the model. This is a small cap company, market cap $1.5 billion. They're trading at $28.38 a share, and they have 52 million shares outstanding. Let's look at their financials. Free cash flow is how you value a company. You estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And if a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things unless it takes cash off the balance sheet or goes into more debt. This company has positive free cash flow in 2 of the 4 years, negative in 2017 and 2020. Net income is a profit and loss for the business. It's revenue minus expenses. And they have positive and pretty consistent net income each year. Revenue is a sales for the company, and their revenue grew a lot from 2017 to 2018, but it's been pretty steady after that. Their margins are pretty low, 1 to 3%. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. So in 2020, they converted 3% of their revenue into profit, which means 97% of their revenue went towards expenses. Let's look at the financials a little closer to see where they have these two negatives. In 2020, they had $3.3 billion of revenue, $2.8 billion in cost of revenue. These are the costs directly associated with making the company's products. And their gross profit was $526 million. Operating expenses are expenses that are not directly tied to making the products. Examples are depreciation and research and development. So their operating income, although it's not large, it's still positive each year. They have little debt, so their interest payments are pretty low, and they don't have much in the other column. So each year the company has positive net income. Let's look at the statement of cash flows to see why they had two negatives. To calculate free cash flow, it's operating cash flow minus CapEx. And they had negative free cash flow in 2020 and 2017, even though they had positive net income. The way you calculate operating cash flow, you start with net income, then you add back the non-cash items on the income statement. Depreciation is usually the largest. In 2020, they had $84 million of net income. They added back $28 million of depreciation. They also added back $20 million of stock-based compensation and another $15 million of write-offs. So it seems like they should have positive operating cash flow. What brought down their free cash flow was a change in working capital. They spent $200 million in inventory in 2020. When you purchase inventory, that detracts cash. In 2017, they had negative $235 million of inventory. 2018, negative $126 million. But when they use the inventory in their business and pass it on to the income statement, then it becomes a cash positive. So in 2019, they had positive $119 million of inventory. I pulled this little blurb from their 10K. They say, "We generally maintain substantial inventories of our products because the computer server industry is characterized by short lead time orders and quick delivery schedules." Inventory management is such an important part of a business. Obviously, certain companies need a lot of inventory on hand, but you don't want to overdo it because you may be stuck with a lot of inventory that you have to take a loss for. Let's look at a capital structure. $54 million of debt, $1 billion of equity. They pay 4.16% interest on their debt, and cost of debt is 3.46%. To calculate cost of debt, it's interest rate times 1 minus the effective tax rate. And only 5% of the capital structure is debt, which means 95% is equity. Cost of equity is 10.77%. And to calculate the cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. And they have a beta of 1.1, so the stock is a little more volatile than the market. Their WACC is 10.42%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $759 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $700 million. We divide that by 52 million shares. And we get a calculated stock price of $13.35. They're trading at $28.38, so they're trading at a 113% premium. It's a sell according to the model. Simply Wall Street is really close to my valuation. They're at $12.93 a share, so they're also saying the stock is overvalued. Let's see where the stock has been trading the past few years. So the stock was trading in the low 30s at its peak, but it's been up and down for quite a while. This company has never paid a dividend and doesn't expect to pay dividends in the future. If you invested $10,000 in this company 10 years ago, you'd have about $25,000 today. That's 150% return on investment. Let's look at their financial ratios. The average PE in the market is 16.9, the median is 15.2. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 17.7, so they're about average. The average price of sales is 4.7, the median is 2.0. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 0.4, so they're doing really well relative to the median and average. The average price to book is 4.8, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 1.4, so they're doing much better than the median and average. The average interest coverage ratio is 12.6, the median is 3.9. Interest coverage ratio is EBIT over interest expense. They're at 38.3, so they can easily cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. The average ROE is 13%, the median is 12%. ROE is net income over equity. They're at 8%, so they're a bit lower than the median and average. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities. They're at 2.3, so they can easily cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios is to compare them to similar companies. I've done videos on Canon, Arista, HP, all in the same industry as Supermicro. And if Supermicro has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're a little worse than average in price to earnings ratio. They're much better than average in price to sales and price to book. They're at 2.3 current ratio, which is below average, but it's still a decent ratio. ROE, they're better than the average because the average is negative. And they're much lower in debt than average at 5%. Average is 29%. They are the smallest company of the group, so when you invest in a smaller company, there is more risk. Their market cap is only $1.5 billion. The average is $15 billion. And they don't pay a dividend similar to Arista. So to summarize, I have them trading at 113% premium. Their ratios and financials look decent. So let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.